so we've only just started with the intros.
Okay.
So you haven't missed anything. So yeah, Pete and I will take you through this quite interesting section on rollovers or restructures. And I guess the first question really is why do clients restructure? And no doubt you've seen it in your own practices for various reasons. The business has grown too big for the current structure, and asset protection. A lot of them, those two sort of dovetail into each other. The structure that a client might have set up originally may have been the business in one entity, and then acquired PP&E, and then acquired buildings, etc. And so having the business and the buildings in the one structure may not be ideal from an asset protection point of view. So that's one of the reasons why you might want to split that structure a bit. Going back to business growth, you might have an individual, or you might have a trust that has grown and now wants to introduce some of its employees to have equity interests in the trust, in the business rather. So you may look at rolling into a company so that you can then issue shares to the individual. So there's that business growth scenario there. Succession planning as well. So mum and dad might have the business and they might want to, they'd love their children to take over, but sibling A and sibling B may have different ideas about how to structure things going forward. So that's another reason. Preparing for sale, and what we mean by that is, it's actually as an example, we saw a client who was a PAM client rather, so it was their client, and they were looking to sell their entity, and their entity was units in a unit trust. However, the purchaser didn't want to buy units in a unit trust, so they had to come to us, and we had to pretty quickly restructure that. So we used the Div 615, which is what we'll talk about later. But again, that's one of the, I guess, one of the things you need to consider, stepping in the shoes of the purchaser. What is it that they want to purchase? And in that instance, they wanted to purchase shares in the company as opposed to units in a unit trust. Tax advantages, I spoke to Sean about whether or not we should actually have that on there, because you might have heard of Part 4A. But the end of the... Sorry? What?
Why is it West But
the thing with that one is, as you can see, it is ranked number 4. So the main reason, all those other reasons are the real reasons why you do the restructure, but there obviously will come some tax advantages, or there may come some tax advantages from doing so. And you're looking at mainly, if you're in let's take the basic case of an individual who's now paying 47.5% as opposed to, if they were conducting their business in a company, having at least been able to retain profits and pay the tax in the first instance at 27.5% and then pay franked dividends. So there's some obvious advantages there. And you've probably seen the last one, all of you, I'd say, to fix a mistake. You've got a client that comes to you that is a new client, and their structure is all wrong. They've either not sought advice or got the wrong advice. So that's probably something you've probably seen, I'd imagine, over the years. So that's another reason why you would consider restructure. So I guess what the takeaway today is, what we're doing with these restructures is that we're deferring the gain that would otherwise arise, or disregarding the gain rather. We're not actually creating any other advantage, and by saying that, effectively the new owner will step into the shoes of the old owner. So all the tax, generally speaking, all the tax attributes that the old owner has will effectively be transferred to the new owner. So that's in a nutshell why we need to restructure, and I guess the advantages of doing so. So what I want to do is just quickly cover what we're looking at today. So I'm going to do the first 4. Now the first 4 rollovers there are aimed at either small business or large business, so it doesn't matter. Anyone can access those. So we're looking at the 122A, which is basically an individual or a trust disposing their assets into a company. We call Div 615 corporatising a unit trust, and there's 2 parts to that. There's a unit trust being then a company interposed between the unit trust and the unit holders. So you then have the unit holder, the shareholders the company than the unit trust. So obviously that way the unit trust can pay frank dividends up to the holding company. But then as a further step, and we'll look at this, for me to truly corporatise a unit trust is to then, if it works, and I say if it works, form a tax consolidated group with the company and the unit trust, and then you can move all the assets from the trust into the company, and then you can get rid of or vest the trust, and you're just left with a clean corporate structure. But again, we'll talk about that when we get into it. Anyone familiar with what's happening with Channel 9 and Fairfax at the moment? Yeah. So they're doing a 124M. So effectively, Channel 9 are acquiring the shares in Fairfax by doing a share swap. But that's not, and that is obviously a big end of town issue. But I do a fair bit of this stuff with tax consults, and I'll show you how that works, and that's sort of that SME market. Interesting, we talk about merger in 124M. 125 is a demerger. So Wesfarmers and Coles are demerging at the moment. So what will happen is that the shareholders of Wesfarmers will end up being shareholders of Wesfarmers and Coles. Okay, so you've got your merger in one instance and your demerger in the other instance. Again, we can also talk about that and how it applies into that sort of SME space. Pete will then take us through the small business restructure rollover, which is quite interesting, really interesting stuff through 28G. Fairly new set of provisions, and I think we've just seen the first year's worth of them being applied. Yep.
2017.
2017. Yep. Any of you guys use those in your practice?
No, but you avoided Part 4A, I take it?
Can we?
Oh, yeah, because you've still got that Part 4A.
Oh yeah, with everything. Yeah, Peter will walk you through that, but there's a fair bit with respect to integrity in being able to use them anyway. So there's a lot of integrity measures in there anyway. So that's what we're going to cover, and then Peter will walk you through the case studies as well. So, Paul, your favourite topic, mate, 122A. Yeah. So it applies for either a trust, and that can be discretionary, or a unit trust, and or an individual. And let's just say, like, we've got a trust carrying on a business, and what it wants to do is effectively roll that business into a corporate structure. For all those reasons that I discussed at the start, the trust structure is no longer appropriate, and now we want to, or the owners want to roll that business from a trust into a company. So that's the basic premise of it. So before or after, basically the trust will end up owning all the shares in the company, which will then carry on the business. So, as I mentioned, it can be either individuals and trustees. This is 122A. If we look at partnerships, which is outside the scope of today's session, we look at 122B, which has got a similar set of provisions. One or all asset transfer basically means that you don't have to transfer every asset of the business. You can transfer whatever you like. So it might just be the goodwill, or it might be some PP&E, it might be some buildings. So you can pick and choose which particular assets you transfer. The consideration is restricted to shares. So it can't be cash, for instance. So it's got to be shares. That's the only thing that you can get for consideration. Or shares with the assumption of liabilities, and that sort of dovetails into number 2, the market value test. So in order to make this work, what you normally do is you normally set up a clean skin company to do the acquisition. Is that what you've considered? Yeah, tick. And so, yeah. So the idea is, and the rules are basically that the market value of the assets the market value of the shares that are issued have to be substantially the same as the market value of the assets that are transferred, less liabilities that are attached to those assets. So in a real simple scenario, if you've got an individual trust and they're operating a business, they have, say, $2 million worth of goodwill, then when they've got the company will then effectively acquire that goodwill for the issuance of $2 million worth of shares. That's how that works. So it's got to have that type of arrangement. And the beauty with the clean skin is that you don't have to go and have a valuation, because you've got a company already that has value in it and it issues shares, and you have to then do a valuation to ensure that what it's issuing is what it's getting as well. So it's clean skin, there's no requirement to have that valuation, so that's a good tick. And as we said, in the end, trustee or an individual owns all those shares. But the good thing about that is, and remember how I said at the start, you may want to introduce another employee to then buy into the business or buy into the structure at some point. You could effectively do the rollover on 1 July, and then on 2 July you can issue shares to key employees or lot shares if that's what you want. So there's no requirement for this to be a forever lasting arrangement. It just has to be that individual trust owning the shares at the time, or immediately at the time that the transfer occurs. Importantly, we choose the 122A rollover, but how do we do it? Normally through what your client will fill in the return by the fact that they don't put a capital gain in. Will mean two things: either they made a mistake and didn't understand or realise that they should have, or they've applied 122A. Of course, what we do, and we recommend that you guys do with all your clients, is have that documented, have that election actually documented. Hello.
Sorry.
Yeah, you're right. Are you Maya?
Mine, yes.
Thank you. Have we got a set for Maya? Yeah. Excellent. Yeah, so we would certainly certainly recommend the documentation of the 122A rollover. 5 this is where all the magic happens. So the individual has trust has disposed of their business to the company, and so any gain that would otherwise arise is ignored, disregarded. So if the individual disposed, even though we talked about this issuance of $2 million worth of shares, if the individual had a tax cost base of nil for that goodwill because they've started the business themselves, then the company will then assume a tax cost base of nil. So forget what that consideration is for the shares, and as we said before, the new owner steps into the shoes of the old owner. Similarly, if that individual started the business 30 years ago and it's a pre-CGT business, the company then acquires a pre-CGT business as well. Okay? And in saying that, I think that's it. From an individual perspective, the cost base of their shares will be then equal to the cost base of the asset less the liabilities that are attaching. So again, it's same for same. So just to reiterate that, because I know it can be a bit confusing, the company will pick up the cost base of the asset, of the cost to the individual for their acquisition of the business. The individual will then disregard a capital gain, and the individual's cost base in the shares will be effectively the cost base of the asset less liabilities. So they're the key features of 122A, and I'll discuss number 6 just a second ago. And again, going back to the things that we said before, it enables asset protection, obviously, and particularly if you're going from an individual to a trust. You just shrank. It importantly allows untaxed trust income to be replaced with franked dividends. Obviously, you've got a trust, you're paying a dividend to a company, it can sit, the company will pay tax at 27.5% or 30%. It can sit in the company, then the company will pay the dividends when it's ready to the shareholders, and they'll be franked, hopefully. So that therefore gives you the ability to retain profits. We've got there that timing from 1 July is preferable, but we say that just from a clean perspective. I mean, that's not to stop you from doing this at any point in time. And I've just mentioned the consequences for the trustee and the consequences for the company. So it's quite a neat one. There's a few things we need to talk about though. So we've talked about the capital gain with respect to the disposal of the business. So let's look at trading stock. So if you decided to shove trading stock across, but remember you pick and choose which assets, okay? You don't have to move everything across, but if it made sense to effectively start trading in a different entity, then the likelihood is you move everything across. So trading stock is CGT exempt if it's trading stock in the hands of the transferee and the transferor. However, where trading stock is a little interesting is the trading stock provisions will actually deem an assessable event to occur where the transfer is not in the ordinary course of the business. And this would be seen as not in the ordinary course of the business, and therefore there is a possibility that there could be some assessable income coming through. A couple of ways out of that, and it depends on what the business is, but if the business is a retailer, then there may be an argument that the wholesale cost is actually market value in this particular related party transaction. I'm not saying that it's a 100% argument, but that might be an argument. And in doing so, you then hopefully effectively transferring at a cost. The other way out of it is possibly to get the trust to effectively to retain some of that trading stock and then sell directly to the customers. Okay, so you're effectively winding down that stock after the transfer, and it's going to stay in, obviously any profit will be then effectively retained in the trust, and then we can deal with that separately. So there's a couple of little ways out of it. PP&E, thankfully there's a balancing charge rollover, so you can transfer your PP&E across. No, any balancing charge that arises will effectively be rolled over as well. So interesting though, effective lives are still the same, so you can't change those. So then you may be able to self-assess going forward in the new entity for whatever reasons, but prima facie you can't change them, and you can't change the method that was originally used as well. One of the, and you know, we talk about all these nice things, and it's all been positive so far, but one of the really crappy things about this in WA, and let's go back to my $2 million example. You transfer $2 million of goodwill from the trust to the company, and effectively, for all intents and purposes, and I'm looking at a discretionary trust here, for all intents and purposes, you're effectively selling something to yourself. You're going to pay $100K worth of transfer duty in WA and Queensland if you do this, right? So that is one of the reasons that people don't use 122A as much as they otherwise would, because of this insidious cost that is just attached, which makes it prohibitive to actually do the transaction. Now, the WA government, the abolishment of duty on this transfer has been in front of the WA government 3 times and has been knocked back 3 times on the basis that the WA government can't afford to not have the revenue. So, in saying all that, that may be a different story with all the GST covered up now. So that's something that you really need. That's definitely your cost benefit analysis right there. You're going to have this upfront $100,000 cost on a transfer of goodwill that you're really not going to get any benefit on. In saying all that, that's for a discretionary trust. A unit trust should be able to qualify for the exemption. And the reason for that is a unit trust and a company are considered to be part of a family group for revenue purposes, and that's because of that fixed ownership. Same with a company and a company owning a company. Discretionary trusts aren't considered to be part of a family because there's not that effectively that direct ownership. That they can't actually be made part of a family because they've got that discretionary part to them. So whilst it's bad news for a discretionary trust, you can apply for the exemption for the unit trust. So that's good from that perspective.
Adriano, do you know which provision that unit trust could qualify for exemptions?
Which provision?
Yes.
Yeah, it's actually called the reconstruction and
Which you must
consolidation.
own more than 90% or more.
Sorry, what's that?
Which you must own more than 90% or more of it.
Yeah, yes, correct. And it's yeah, that's right. And it's called either the consolidation or relevant
reconstructions.
reconstruction provisions. Yep. Okay, so that's 122. Yeah, that's 122A. Now this is fun too. But I do a fair bit of the second part of this, which is the tax console bit. But let's think of, and I'll just have a water first, thank you. Anyone else need some water, some juice there, some coffee? That's hot too. Just found out. So let's have a look at the scenario where you've got a unit trust and you want, again, it's called corporatising, but let's look at the first part where you effectively you interpose a company between the unit trust holders and the unit trust itself. So from left, you've got your two shareholders and your unit trust, and on the right, you've got those unit trust holders becoming shareholders of the company, which then owns the unit trust. Now, what that obviously allows you to do is pay frank dividend, pay distributions into the company. The company then pays the tax at 27.5%, retains profits, then has the ability to pay frank dividends. So that's obviously a fairly obvious sort of reason why you would do that from a retained profit and growth perspective, trying to grow the value of the business from within. And as I said before, from a tax consolidated point of view, it also works too, because you can actually tax consolidate the company in a unit trust, and because to have a tax consolidated group, there's a misnomer. People think it's just got to be a company, but company doesn't have to be a company and a unit trust, but a company has to be the head company. And again, I'll talk about that very, very shortly. So this only applies to a unit trust. Discretionary trust can't get this rollover. If you want to do something crazy, if you want to do something inventive with discretionary trust, you're going to look at 122A, where you roll effectively the business. So the rollover is effectively the unit holders. So the unit holders are disposing of an asset, being the units, and they're hopefully probably making a gain. If they're making a gain, then they can elect under this rollover provision to have that disregarded. One key thing here though, and we from a policy perspective, we don't quite get why, but you see up the top on the left, there's a trust in the trust, so there's two unit holders. You must have at least more than one unit holder. So if that was just one trust holding the units, you wouldn't be able to access the 615. So you've got to have you've got to have more than one unit holder. Shares can be the only consideration here, and that therefore there's no cash that can be issued. There's also that the proportions have to be maintained. So if you have two shareholders, they own 50-50 of the unit trust, then they have to own 50-50 of the company immediately after the event occurs. Same sort of thing with the value with respect to the market value of the assets, or the market value the market value of the shares issued have to be substantially the same as the market value of the units acquired. And at the end of it, effectively, Newco has to own all the units of the unit trust, and the ex-unit holders have to hold all the shares. Now, what I like is obviously that there's a gain that is disregarded. So the unit holders, the cost base of their shares, again, remember we talk about stepping into the shoes. The cost base of the shares is equal to the cost base of the units. So if they only paid $100 for the units, the cost base of their shares is $100. It's really interesting for the company. The company's now acquired these units. The cost base of the units is actually equal to, and you've got to look at the balance sheet, it is equal to the cost base of the unit trust's assets. Right? Cost base, not what's in the balance sheet, but cost base less the liabilities that are in the balance sheet. So again, you may have an asset that has been revalued in the balance sheet, but you've got to use that tax cost base, okay? And then the liabilities come off that tax cost base. And as we've mentioned, the unit trust income is obviously taxed at the corporate rate going forward. Now, so there's, I mean, you can do this, and there's plenty of reasons just to stop there, to do 615 rollover. But the stage two, and I think that's what you were referring to in your discussion with Pete beforehand, yeah, is, and I'll say if this works, then you could look to form a tax consolidated group. Now, tax consolidation is not a tick in the form and that is the end of that. Tax consolidation involves a very complicated 7-step process to come up with what's known as an ACA, which is the allocable cost amount. It's effectively pushing down value into pushing down the deemed purchase price into the value of the retained assets, of the assets of the unit trust. Now, the issue we've got with this is that when you do an ACA, it may not always give you the right number. It might come up with a number that doesn't actually work. And so you may not go and do the tax consolidation process. If you then, and so what we normally do in this regard is we do a high level number to ensure that it does work. If you do then decide to consolidate and there's no adverse findings from the ACA calculation, then you form a tax consolidated group between the company and the unit trust. Once you're in a tax consolidated group from a income tax perspective, any transactions between the two are ignored. Okay, so what you do have to ignore the tax effects of those transactions, you do have to form a tax consolidated group. So you can then move all those assets from the trust into the company, no income tax, and then you can vest your trust. You vest your trust, and then all you have is your company. And you've got this one company that effectively is now running your business directly. The good things, unlike what we spoke of before with the 122A, there won't be any GST on the transfer of the unit. Sorry, there won't be any. I'll go back a step. One thing I did mention when we talked about the transfer on 122A was GST. I didn't mention that. I apologise. I only talked about transfer duty. Generally, when you transfer, say, a business, GST would generally be applicable unless you apply the going concern. So, if you complied the going concern, then you wouldn't have GST on that disposal that we talked about. When you're disposing of units, we don't have to worry about GST on the disposal of the unit. WA duty again is actually gives you a better result here. Again, transferring the unit itself, there won't be any transfer duty per se, unless though the unit holder is a landholder. Or sorry, the unit trust is a landholder, and a landholder means that it has to have more than $2 million of effectively land and buildings and the like. Unencumbered value's got to be more than 2 million. Even if it does, and you're transferring units in a landholder, there are duty exemptions that will apply. And again, we look specifically at the reconstruction consolidation exemption, and then when we look at step 2 and we're moving those assets from the unit trust into the company, we then look at again an exemption through the relevant transaction exemption. So these exemptions are available. You have to apply for them, and you can do it either before or after. And if you do it after, then you've got 12 months to effectively get your application in, but there's no reason in those sort of circumstances why the OSR would not grant you the relief. So at least under this particular transaction, unfortunately, it only applies to unit trust and not trust, but at least we've got that, we don't have that issue with the duty. All right, we have another drop. Swapping shares for shares. Now, at the start of the show, I talked about talked about Channel 9 consuming or purchasing Fairfax with the issuance of shares. So not only can we apply that perspective on all those principles in that big end of town, we can do it for your SMEs. So you might have company A, you might have company B, and they're owned basically within the same family, a group of shareholders within the same family, so to speak. A might have losses, B might have gains, or A might have franking credits, and B may want to use those franking credits. If you don't merge them and don't form a tax consolidated group, you won't be able to effectively use any of those benefits. So, and again, I look at this a lot with tax consoles. So what this does, the 124 enables effectively company A to go over company B, or company B to go over company A, either or effectively a head code to go over company A or company B. So it's effectively a swap of shares for shares in order to get that structure to start off with. On that right-hand side, the left-hand side you can't tax consolidate, the right-hand side you can tax consolidate that group. So I've just mentioned those first 2 points there. The key condition is this is a share swap, so it has to be shares for shares. It has to be. 615 is units for shares. This must be share for share, life for life. Again, those market value requirements that I spoke of before, and the market value requirements with respect to, if you've got, assuming $1 million worth of shares, you've got to be effectively issuing $1 million worth of shares for those, or for the original shares. Substantially the same terms basically means that every shareholder has to be offered this at substantially the same terms. So in that Channel 9 Fairfax scenario, that's going to happen. But if Peter and I, for instance, were looking at doing something like this, merging our 2 entities, he couldn't be offered a 1 for 3 and me offered a 1 for 2. It has to be on par, right? So it has to be the same. The acquiring entity has to get at least 80% of the shares of the original company for this to work. So in that SME space where we're reconstructing like that, it should always happen, because you would think, in particularly my example, that we had that 100% acquisition. Where it may not necessarily happen is in that Channel 9 Fairfax, where they might get less, but you will find that in the prospectus and in the target statements, that there'll be some condition. I haven't looked at this, but I suspect there'll be some condition that will say they'll need at least 80 or at least 90% for the deal to go through. And there's 2 reasons for that. 90% gets them compulsory acquisition from an ASX point of view, and they will all know that the shareholders will want to be relying on this rollover. So they'll ensure that they'll get at least 80%. All shareholders have to participate in the offer, and that's an interesting term. Participate means being offered, right? So in our example, we couldn't look at taking out Pete's shares and not taking out my shares. We all have to be offered. Now, he might say yes, and I may say no. If we were both offered, it doesn't matter what the result is. It's the fact that all the shareholders need to be offered in the first instance. So again, those tax consequences, thankfully, as we mentioned, we disregard any capital gain. So when the big company, either A acquires B, or you have the interposed acquiring both of those companies, there's obviously a CGT event there. So that gain is effectively subject to rollover, and therefore it is disregarded. So again, with the original shareholder, the original shareholder will take on their cost base of the new shares will be the same as their old shares. Okay, so if they had $100 was what they incorporated company A with, then the shares that they get in the new code will also have a tax cost base of $100. I want to have a look at, and it's really interesting, we've got here practical application in forming a group and then tax consolidating. So if we look at this particular structure here, what I like is obviously that you can't consolidate, but as I mentioned before, you could actually run the demerger so that owns that or that owns that. You don't have to go into that scenario, but I'll give you a practical example when I did this. We did it just before 30 June where an accounting firm, funny enough, and two accounting firms actually merged. And this is exactly how we did it. We did this scenario here. So we applied the 124M for both of those entities. And then we will also look to form a tax consolidated group. So just on consolidating, it's not something you just don't go ahead and do. You've got to do your numbers. You've got to run your ACA to make sure that whatever, if there are costs involved in doing so, that they're not outweighed by any benefits of consolidating. So once you tax consolidate, you do one tax return. I mean, like once you get past that stage of doing your two ACA calculations in this instance, going forward, you have one tax return, and this is just one tax consolidated group. So any transactions between the two will effectively be ignored, and that's the beauty of tax consolidations. I'll just quickly ask, within your firms, what's the sort of take up over the years for tax consolidations?
Pretty low.
Pretty low, yeah. Because tax consols is always seen as, not always, but is seen as a big end of town thing. But it shouldn't be, because SMEs can take advantage of forming tax consolidated groups. Now, did any of you guys go to, was it our PAN conference?
Yeah.
In March? No? Anyone? No? Are you there, Jerome?
Yeah.
Were you there for my tax console session?
I believe so.
Yes, you were.
Between that and
Yeah. So that was based purely on the benefits of tax consolidating in an SME environment. So yeah, 124M is your first step, and then you look at tax consolidating thereafter.
Just on that one, Adriano,
Yeah.
we looked at a few, we didn't go ahead with tax consolidation,
Yeah.
also to do with shifting losses
Yeah.
of the family group.
Yeah,
But one of the things that we hit the brick wall was the losses were pre-consolidation.
yeah. So,
So you still have to pass the court test and all the rest of it.
but not only that, you have the COT test, you have the SBT, but then you have this thing called available fraction.
Yeah.
So
One is talking about those topics, your client just turn off and
yeah. Well, with the available fraction, so it's better going forward. Once you have that consolidated group, any losses you may will get you straight away.
Absolutely.
Right? It's the ones that are transferred in that are drip fed according to available fractions. So sometimes they're even cancelled. Sometimes we don't, because what happens is they actually affect the ACA calculation. So if you bring them forward and bring them into the group, then they reduce your ACA. It's great. It's better to have more ACA than less. So there's a trade-off, and that's why what we normally do is when clients are thinking about a 615 or a 124 and then consolidating, we actually do the consolidation exercise, the ACA high level first. So we know if there's any issues, and if there are no issues, then we go backwards and then we do the 124 rollover and then formally consolidate. So that's a way, and you might have heard me rabbit on a long time in that particular session. I said, do your homework on your ACA. Do not, and we've seen this too in our own practice where clients have consolidated themselves. So they've signed they've ticked the box and they've actually sent that to the ATO. So they've notified the ATO that they've formed a tax consolidated group without doing any of the work. Then for us to realise when we're doing the tax return that they've consolidated, and to then realise that consolidating has actually caused them a really big tax headache. So yeah, so it can be daunting. That there's no doubt about that, but there's definitely advantages to consolidating at that SME level. Now, before I head you over to Pete, talk about very sort of broadly. What's this one? I've done that. Now, this diagram is a little hard to follow a little bit on the right-hand side, so I'm going to use my hands. So you've got a big company, and it has a subsidiary here underneath it. and I'm saying big company, head company. All right, so Wesfarmers, Coles. So shareholders, Wesfarmers, Coles. What a demerger does is take Coles, brings it here, so that the shareholders now own Wesfarmers, and the shareholders now own Coles. Does that make sense? So that's what a demerger is. So what are you doing? So from a tax perspective anyway, and I'll talk about 45B in a second, but you've got to show that this is a genuine demerger. And one of the ways you show that there's a genuine demerger is probably the reasons why Coles and Woolworths, Coles and Wesfarmers, there's so many big companies out there, Coles and BHP, why Coles and Wesfarmers are demerging. Their arguments will be that Coles being owned over here will have a better chance of being run more efficiently. So there's a business efficiency case with respect to that. And then in turn, because they'll have their own board, etc., and in turn, by having that business efficiency, a greater chance of returning better value to the shareholders. So that's the sort of reason why you would do that. I did this, and when I say I did this, I sat in this boardroom just before June, and we had a PAN client, and he brought their clients with them. There were shareholders. They said the business had been set up so that the company owned goodwill, or the business, and it owned land. They were wanting to exit one of the owners from the business, but then that owner wanted to retain the interest in the buildings. So we didn't go ahead and do the transaction, but one of the things that we suggested to them was this, a demerger. So we looked at effectively, and this is when my favourite tax consolidations comes into play. So the company that owned both the business and the buildings incorporated a new company underneath it, moved the buildings down below, and then demerged that, so that the shareholders owned a company that had the business and the shareholders owned the company that had the buildings. We could then, after that, sell the interest that that shareholder had in the entity that owned the business, and she could still retain the interest in the buildings. So that's basically what the gist of 125 and how the mechanics work. How it actually works theoretically in practice is those things that I've just mentioned there is basically what we need. We need that head entity, and we need a subsidiary entity underneath it, or even it can actually work in a unit trust. I've never seen it work in a unit trust, but it can work in a unit trust. So obviously, if we were to demerge that particular entity, if it went from the being owned by Headco to then being owned by the shareholders, there'll be some CGT implications. Now, for the original shareholders, the main way to do this is to do a return of capital. And you do the return of capital by satisfying the return of capital by doing that distribution of the company underneath. It's an in-specie distribution. By doing that, however, there'll be it's just much like a share buyback, there'll be a component that is subject to CGT, and there'll be a dividend style component. So the component that is subject to CGT, any gain you make on that will be effectively disregarded. Okay? The unit holders, the shareholders will have now an interest in two companies. So the cost base that they had originally in Company A will be split between Company A and the new company. So there'll be a reduction in the cost base of Company A and some cost base allocated to Company B. There is also, and I mentioned that there's this dividend component, that will also be non-assessable because a demerger dividend is non-assessable. But there's a big but with this, and there's a big but that happens at that corporate level, the big but is it happens, it's always going to happen, but it's going to affect that private end more than it will affect the larger end. And there's one of the things that we brought to the attention when we talked about with those clients about the demerger was the application of what's known as 45B. So 45B is an integrity provision to ensure that that non-assessable, non-exempt part hasn't been manufactured. In other words, if you're making an in-specie distribution, are you effectively, the question will be, are you effectively distributing an unrealised gain to the shareholders? And that could be the case. And 45B is an integrity measure which looks at the following things. Why are you actually doing this particular restructure? Is it a genuine demerger? In our instance, we thought we had a very, very good argument because we were trying to exit one of the shareholders. It was really the only way of doing it properly, or certainly less messy way of doing it anyway, and less costly from various points of view. But that is the question. Is it a genuine demerger? Is there going to be business efficiency? I talked about business efficiency before. Is one of the reasons, and it only has to be one of the reasons, is one of the reasons why you're doing this to get a tax benefit. Now, you might remember Part 4A, you're looking at sole dominant purpose. This is much broader. So in that sort of, I guess, that corporate, that SME space, where we have to be a little worried is because we might do a return of capital. As I mentioned, we're only probably going to have $1 or $100 worth of capital in our share capital account. So where's the rest going to go? It might go into a reserve, but is that actually distributed? Is that effectively, and the ATO will ask the question, are you disguising the distribution of profits? So nearly every time when we do anything that has anything to do with 45B, we go to the ATO for a ruling, because that is the only way you will get certainty. So I'm certainly not saying it's impossible. It is possible, but you've got to be careful with the reasons as to why you do it. And then obviously the last point, once the head company is effectively, once it demerges, if or two has a CGT event because it's sold shares, or not sold shares, disposed of shares in the subsidiary, that gain is disregarded. So you're probably surprised that we're talking about 125 in an SME context when we think about mainly that sort of Channel 9 Fairfax, but it's not to say that it can't apply where the reasons are right in the SME market. So with that, I'm going to hand you over to Christine to head on. Who's now going to talk about Section 328G. I think lunch is coming soon, and then we can go through the case studies, and then we can have a general chit chat on any of the questions you might have.
Thank you. Now, the last rollover I will talk about this session is the small business restructure rollover, and this is also the most recently introduced rollover. They are specifically aimed for small businesses, and this is what the government basically identified. There was a bit of a gap in this space. If you look at the big end of town, like listed companies, or what sort of structure they use, pretty much companies, right, or group of companies, probably unit trust or listed property trust. Now, with all this structure, you have the script for script, you have demerger, and they basically use this to have this CGT rollover relief. However, what about small businesses? Now, small businesses, they are more diverse, isn't it, in their structure. They have, for example, individual as a sole trader. You can have partnership. You can have trust, discretionary trust, unit trust, and as well as companies. So if you look at previous being discussed, what you have is quite limited, isn't it? 122A, for example, it has to go to a company from individual to trust. There's also a sister provision, 122B. We don't discuss that in this session, but similar provision, basically partnership to companies. So everything ends up in a company. Now, this is where this new restructure rollover comes in. It is wider than the existing one. For example, under this restructure rollover, you can restructure from an individual or sole trader to a discretionary trust, or what we call colloquially family trust, now, or even company. Now, why would you do that? First, for example, there might be asset protection. See, you're a sole trader, and if you got a discretionary trust with a corporate trustee, you get a bit of a limited liability there, because it was a $2 company that now becoming personally liable rather than the individual. However, there's also side benefit or tax advantages of doing this. Not to say that this is your main reason that you would like to do that. Under discretionary trust, then you can suddenly, you have an access to a range of beneficiary where you can, there's a bit of flexibility where you can distribute your business income to, isn't it? So that's the first one. The second, you can distribute from, you can restructure from one discretionary trust to another discretionary trust. Now, under this scenario, you probably want to do it because, for example, you started as a small business in a discretionary trust, and it grows bigger and it becomes different, very different kind of business or different branches. And what it is then, you're thinking about, for example, succession planning. You're thinking about passing it on to your next generation, and you want to split up the business. This is where it comes, it's basically allow you to do what they call trust splitting. You do have two from trust to trust, and then you business two, you move to the new trust, and then it becomes, and then it will be run by, for example, your kids or even key employees, etc., as whatever the commercial reason behind it. Now, the next one is you also can do under this new restructure rollover is what you want to move from company out to family trust or individual. Now, why you want to do this is because, for example, you want to wind down the business. In a company, you have, for example, administrative burden, and being in the company, you have to have a lot more compliance costs, and over time, the business probably become a little bit simple, and you want to simplify your business affair. Under this rollover, you actually have a little bit, there might be a tax issue as well, or advantages depending on what your scenario is, and I'll discuss that later. Not only it applies to a wider range of scenario or structure, it also applies to a wider range of asset. It can apply to your usual asset, CGT, depreciating asset, and also trading stock. Adriano mentioned before under 122A, your trading stock might be accessible under DIP 70, where it was a disposal outside the business, ordinary course of doing business at market value. So under this rollover, there's actually a relief, so you basically inherit at cost the trading stock. So that's handy if you prefer to do it under this subdivision. Now, the rollover is available from 1 July 2016, so it was fairly recent, and there was only a couple of guidance from the ATO, new rulings, and apart from that, you have to rely on explanatory memorandum. So I'm sure over the years, hopefully we can get a little bit more clarification from court cases, tribunal, that kind of thing, or even more ATO rulings. However, I would go through all that requirements and see whether we get a bit of an understanding and see whether this is something that we can take away and apply for our clients. Now, if you want to use this restructure rollover, you need to satisfy certain conditions. Basically, the first condition is the transaction must be a genuine restructure of an ongoing business. Now, Adriano mentioned before under the demerger relief, there is a requirement to be a genuine demerger. Now, this is not quite the same, but it is a genuine restructure, and I will talk about what that terms mean later on. The second requirement is both the transferor and the transferee must satisfy the small business entity requirement. Third condition is under the restructure, it must not result in a material change in the ultimate economic ownership of the assets that are being transferred. Now, I will talk a little bit more about that ultimate economic ownership later on. The next condition is the asset must satisfy the active asset conditions. Now you might probably be quite familiar with the active asset requirements under the small business CGT concession. Now this one is slightly different. I'll discuss about that later, but you can see there is a bit of a small business flavor to this rollover restructure in the sense that it requires it to be SBE and it requires to be the asset to be active asset. The remaining conditions, they are pretty straightforward. Both the transferor and the transferee must be Australian tax resident for tax purposes, and both parties must choose the rollover relief. Now, under this provision, similar to other provision where it basically legislation prescribed that the way you prepare your tax return is the evidence of you choosing this rollover. But however, what we normally do is we also have an election form. We just basically specify under what division that we choose the rollover. We specify the parties. We specify what assets and what the cost base of those assets are, and then being signed by both parties. So that's just as a file note. You don't have to lodge that with the ATO, but down the track, if there is an ATO review or audit, then we know there is something in there. As well as we also do advice for some of our accountants' clients, or maybe for yourself, if it's quite simple, you can put a file note, see whether and list whether on what basis whether these conditions are satisfied and whether your client will be eligible under this restructured rollover. And that file note is well put into your files, and then it will become your position in the event of ATO review or audit. Now I will go through in a little bit more detail some of those conditions. And the first one is genuine restructure. Now, the Tax Act do not provide any definition of this term. So we have to look at the explanatory memorandum and also as well as the ATO view on this. The ATO issue ruling, LCR 2016/3, where it basically provides a list of factors where indicates whether that restructure satisfies this genuine restructure requirement. Now, what are those factors? The first one is basically the restructure must be, there must be a bona fide commercial arrangement. What does that mean? So effectively, it means that there must be a commercial reason behind this restructure. Now, for example, what are commercial reasons probably that we can think of? One of the first things that come in mind is asset protection, and then the ATO in the ruling also provide a few examples. For example, the enhanced business efficiency, facilitate growth, where you need to raise new capital so that the business can continue to grow. So all these are bona fide commercial reasons behind the restructure and should satisfy the genuine restructure requirement. Now, what about succession planning? I mentioned before there is a potential to do under the succession planning. And surprisingly, in the ATO ruling, the ATO says no, succession planning does not satisfy genuine restructure requirement. Under that ruling, this example, where it provides basically the taxpayer want to pass on his business to the next generation, and basically he has no intention to continue his business, so he want to just do this restructure, pass it on, and then retire immediately. Under that circumstances, the ATO concludes that because it is not a genuine restructure of an ongoing business. I suppose the underline here is an ongoing business. So it must be ongoing. This restructure is meant to facilitate where you sort of ongoing business, not a step to divestment or preparation for sales, which probably under that specific succession planning falls under. So it also corresponds to the last point that I have there, which is it must not be a step to divestment. Now, however, what you can do then is, if you do a bit of a planning, for example, you have 5 years or 10 years time frame where not necessarily straight away handing down to the next generation, but in 5 year time or in 10 year time, but then you undertake the restructure now. So this is like quite different scenario, and arguably it should still satisfy the genuine restructure requirement. So that's why you need a bit of a planning ahead if you want to use this restructure. The second factor is the ATO mentioned that the beneficial ownership of the asset transfer must not change. So what that means is that there is a bit of an overlap with the ultimate economic ownership requirement, which I'll talk about later. So if you satisfy one, then you should satisfy the other. The next factor is the asset must continue to be used in the business, and effectively, again, corresponds to the requirement that it must not be a step to divestment or a step to sell your assets. The next factor is quite interesting, actually. Basically, what the explanatory memorandum and the ATO say, they accept that if the taxpayer, when they initially set up their structure, they didn't get a proper professional advice, or even they didn't get any advice at all, and they went on to set up a structure, and then later on, under professional advice, probably us, as the tax agent, say, look, we've reviewed your structure and we think it is not appropriate, or there could be a better structure that you can operate your business under. Now, the ATO accept that this is a genuine reason, and you should be able to satisfy this requirement. Now, this is probably good, especially in a scenario where we might inherit new clients from other accountants, and then as part of that review, we noticed that they might be able to restructure and they might have better structure going forward. Then we can use this as, I suppose, as a reason to satisfy this requirement. Now, something to think about. The next one is the restructure must not be artificial or unduly tax-driven. As you can notice, this is probably quite standard, and Part 4A as well can strike down if it is artificial or there's a dominant or sole purpose is to get the tax benefit. However, interestingly, the ATO said tax can still be a factor. There's an example in the ruling where it says a sole trader under the highest marginal tax rate can then roll over to a company where there is a company tax to utilize the corporate tax rate. So under this scenario, and there is a commercial reason behind it, and under that specific example, tax is only a factor. It's not a dominant factor. It's not unduly tax driven. So it's good to know. Having said all this list of factors, so obviously if you look at this, it is a question of facts and circumstances, isn't it? Now, what if there is a bit of an uncertainty surrounding your client's circumstances? The legislation provides there is a safe harbor rule. The safe harbor rule where basically it's meant to provide a bright line test where if you satisfy this, you're taken to satisfy the genuine restructure requirement. What are those rules? Basically, for at least 3 years, after the restructure, you need to satisfy 3 conditions, then you are taken to satisfy this rule. What are those 3 conditions? First is that there must not be a change in the ultimate economic ownership of the significant use of the asset. Again, there is an overlap with the other requirement, but if you satisfy both, then you satisfy this one. Second, the significant asset must continue to be active. So that means you can't, where it was active before, you can't then restructure and then use the asset to derive passive income. For example, you might want to lease the plant and equipment, and then, or if it's property, you might want to rent out to a third party. So in that case, you won't satisfy this requirement. So just gotta bear in mind that. And then the third one is basically there must not be a change in the significant use for private purposes. So the bottom line is that for 3 years, what happened is you need to be before the restructure. If whatever you're doing, carrying on a business, you must continue to do the same thing. After restructure under the new entity, you should be able to satisfy the safe harbor rule. So provided there's no change, like you business as usual, you do a restructure, and then after 3 years, then you're taken to satisfy this condition. Basically, that's what it is. Now, obviously, this is no answer. It's to the problem or all scenarios. For example, there might be other things that might happen within 3 years. For example, the death of an owner, or what if there is a divorce or marriage breakdown where you then have to split the asset, happening within 3 years of the rollover. The third one might be probably you suddenly have an offer out of the blue. For example, a too good to be true offer, and you decided that you want to sell because this offer doesn't come along quite frequently. Now, in those cases, then you won't be able to rely on the safe harbor rule. That means you have to then go back to the genuine restructure requirement, and you have to look at all the factors you have to consider, and then you need to determine whether you're satisfied this. I mean, if there is a death or if there's a divorce, you can argue that these are circumstances outside the taxpayer control, so they might otherwise satisfy the other factors, then it should be okay. However, for example, if you sell it, then you probably won't satisfy both requirements. In that case, then the rollover is not available in the first instance, and you have to go back to amend the tax return, and then there will be a CGT on that, which is not probably too bad, because if you sell it, you would imagine you will have the cash to pay the tax as well. So that's something that needs to be considered.
But the problem there is, Pete, is at the time that you do the rollover, you don't know. That's the problem.
That's correct.
You're not going to know. You're not going to have that visibility. So as you say, it might be that once in a lifetime offer, and the benefit of taking that offer may well totally outweigh the cost of paying that tax, going back and amending the return and paying the tax.
And that's right. And I think this is probably the most, I wouldn't say the most difficult, but probably one of the requirements that give a significant uncertainty in using this rollover, because you never know whether you're satisfied or you get struck down by this requirement. Unfortunately, like I said, because this is quite new, there's no guidance from the court yet on what this term actually mean and where are the boundaries. I give you an example that we recently helped clients to do this rollover. Basically, there's a partnership of, we want to roll over to a company. The partnership is, there's a 70% interest and 30% interest. And what we do in the argument is that it is a genuine restructure for two reasons. First, because asset protection, especially for the minority partner, where you have 30%. If you know partnership, it's jointly and separately liable. And the minority partner is only 30%, but they will be 100% liable if there's anything wrong with the partnership. So in a sense that it is an unfair outcome for the minority partner. And if we put it in a company, there is a 70-30% shareholder, you become asset protection, and the minority partner as well is lead to a better or fairer outcome. Now, and then the second condition, we actually put an argument saying that the original partners, they just went and set up this structure between themselves, and they didn't get advice at the time. And then only when it comes to the attention to the tax accountant, then they say, "Oh, what are you doing? This is not a good structure. And this is another accountant." So they set it up under the previous accountant, and so we can say there is There was a second reason is that it was a lack of advice, and then there was a genuine reason that they want to restructure. If they've got proper advice, they wouldn't have done it in this structure. So that ticked both of them, and therefore it will satisfy this genuine restructure. The first one, they don't have to rely on the safe harbor. So, for example, if within 3 years, then they have to sell the shares in the company, or the company want to sell their business asset. They don't have to rely on the safe harbor rules in this instance. Now, I'll move on to the next condition, is the small business requirement. Basically, under this condition, both the transferor and the transferee must either be an SBE, an affiliate of an SBE, or connected with an SBE, or a partner in an SBE partnership. Now, what is a small business entity? Probably most of us here will be very familiar with that. There's basically two requirements to be a small business entity. First, must be carrying on a business. And second, the aggregated turnover must be less than whatever the threshold. Now, from 1 July 2016, the threshold is now 10 million. So it coincides with the introduction of this new restructure rollover. So this is quite handy, this rollover, because if you look at the small business CGT concession, the turnover requirement is still 2 million. And in the case where the taxpayer does not satisfy the 6 billion net asset test, then they might, but however the turnover is between 2 million and 10 million, then they might potentially looking at this rollover restructure instead of claiming the concession, because that wouldn't be available in their scenario. So this is where the sweet spot, 2 million and 10 million, and where the asset or the net asset is more than 6 million. There's a bit of a gap there. I'll move on to the next condition. Basically, there must not be a material change in the ultimate economic ownership of the business asset after the restructure. The legislation refers the ultimate economic owner as natural persons. So that means you need to trace the interest, and it refers to fixed interest, whether it was directly or indirectly. It doesn't mention what are material changes, but I think if it's 80, 90% still the same, we always require 100% change, then that was really safe. But just bear in mind, I think it was good that we have effectively the same owners before and after, effectively the same group of people owning it. Now, there are two potential issues arising under this condition. The first one, what if there is a dividend access shares on issue? Now, dividend access share is basically a different or a class of shares where it enables you to stream dividend. So, for example, you might have a shareholder A who's holding all the shares, ordinary shares on issue, and then you want to introduce shareholder B, you issue a different class of share, dividend access share, so that you can declare dividend to the shareholder B at discretion. Now, under this arrangement, there's no fixed interest, isn't it? Because you can declare to different classes at the expense even at ordinary shareholder. Now, that means this ultimate economic ownership will never be satisfied. So what you need to do then, you need to review and you need to consider, for example, you might want to redeem the dividend access shares on issue. Most dividend access shares have the ability, or there is a right for the company to redeem it at value, and then they're normally being issued at nominal value, $1, $2 share. So you might want to consider that. The second issue is to do with discretionary trust. Now, discretionary trust by nature, there is no fixed entitlement, and trustee can exercise the discretion to distribute whatever they like, as long as it is within the class of beneficiaries. Now, under this condition, the ultimate economic ownership would not be satisfied. However, the legislation provides an alternative test specifically for discretionary trust. Under that alternative test, you're taken to have satisfied this condition if the discretionary trust makes a family trust election, and it satisfies two conditions. The first condition is that the parties to the restructure must be a member of the family group. So this is probably good when you want to make a family trust election. You need to consider who should be the specified individual and make sure that when you use this restructure rollover, the party, either the transferor or the transferee, will fall under a member of the family group. The second condition is that just before or right after the restructure, the business asset must be the property of the trust. Now, not sure why this condition being introduced, but it effectively severely limit your the potential availability of the restructure rollover. Because if you think about it, what that effectively means is that there must be a trust involved, either as a transferor or as a transferee. To give you an example, let's say if you want to move from individual to company, where the sole shareholder of that new company will be a discretionary trust. Now, there is no ultimate economic ownership of the company because the discretionary trust is a shareholder. But if you elect family trust election, you may satisfy one condition, but you don't satisfy the second condition because it is not the property of the trust just before or right after the restructure rollover. So because the trust only owned indirectly of the asset by virtue of the shareholding. Now, in this scenario then, you might want to consider, instead of rolling it over to a company, you might want to do it to a family trust instead. So individual to family trust, where then it satisfies the condition under the alternative test. I'll move on to the next one. There we go. The next condition is the asset must be active asset. So when the draft legislation came out, we thought, oh, that's sweet. We thought you could sort of move around shares as well. For example, if you have shares in a company carrying on a business where it was owned by individuals, which is not ideal, you want to transfer it to a discretionary trust. We thought as long as the shares are active asset, it will be sweet. However, upon closer reading of the legislation, it basically referred to active asset as defined under 152.40, which is under that section. Basically, it says an asset is an active asset if it is used in the course of carrying on a business. So effectively, what that means is that it's severely limited what class of asset that can be active. It becomes your business, your goodwill, your plant and equipment, or your trading stock. It's those assets that are used in the business. While in your small business CGT's concession, it is quite wide. You can have shares as active asset if you satisfy the 80% test, where the underlying company have 80% or more active assets. However, that is not available under this restructure rollover. So that's something you need to keep in mind. Now, after you satisfy all those conditions and your clients want to use this restructure rollover, what are the outcome? So under this rollover, the income tax consequences is wider. They're wider than the other rollover. In a sense where you have the usual one. For example, your cost base will stay the same in the new entity. Your pre-CGT status also stay the same. This is the normal one, but it goes beyond that. For example, your Div 7A doesn't apply if you utilize this rollover restructure. Now that might be might apply where, for example, you move business asset from company to discretionary trust or individual. Now under Div 7A, because that was in specie distribution, and you're taken to make a payment for the purpose of div 7A, and there might be a deemed dividend. But if you satisfy the condition and utilize the rollover restructure rollover, then div 7A is effectively being switched off, and it is treated as not applying. There's one question that comes in when I was doing this presentation. It was asking, what happens if there is an existing issue div 7A, or what if there's in the future there might be a div 7A? The answer is div 7A will still apply. It only doesn't apply specifically to the asset being transferred out of the company. So specifically to do with this restructure rollover. So if you have, for example, debit loan, an existing one in the future, div 7A will apply. Something bear in mind. Now, there is one significant difference between this rollover and the previous rollover that we discussed about. It is to do with the CGT discount. Now, for the purpose of this rollover, you are taken to have acquired the asset at the date of when you transfer the business asset, not when it was originally being purchased by the transferee. So this is important. Basically, effectively, your CGT discount date is being reset. Now, this is a deliberate feature of the new rollover because the government at the time, they provide an explanation that this rollover is to facilitate an ongoing business. It's not meant to be a step to divestment or a preparation for sale of your business. And therefore, if you use this rollover, just be aware in mind, you need to wait another 12 months until the CGT discount will become available again in the new entity. Now, there is also, we don't know whether this is deliberate or not, but there is unintended consequences where there's a potential loophole that you can utilize this feature of the rollover. Now, if you have, for example, if you have a company, you use this rollover and you want to move the asset out of the company to, say, discretionary trust or individual. Now, if you sell the asset in the company, you won't be eligible for CGT discount, right? But if you do a restructure, you move it out of the company, suddenly what happens is you inherit the cost base of the company, but now it's available, but the 50% discount is available after 12 months of the transfer of the business asset. So effectively, for example, if you have a goodwill where it was minimal cost because the company started the business from scratch, now all the accrued capital gain will potentially be available 50% discount under the new entity. So that was a side effect or tax benefit potentially available if you do a rollover under these circumstances. So the next one is, I'm going to talk, not going to go into the detail, but basically there is an integrity provision just to be aware of, whereby if you try to use this rollover to generate inappropriate capital losses, this might, for example, the explanatory memorandum provide, whereby you have a company with an existing asset, not significant, and let's say there is 100 shares on issue or 1,000 shares on issue, and then you have a significant asset outside the company, and then you use the rollover, you move the assets to the company, and then in consideration for that asset, you issue 1 shares. So effectively, basically, that shares then inherit significant cost base, but then because it was only 1 share, the proportion, it was being proportioned with the existing share, it actually has a market value of less than whatever the cost base, and then when you eventually sell that 1 share, you generate capital losses. So basically, this is where the integrity rule coming from, where then that capital loss will be denied, except where you can demonstrate that the capital loss is not resolved from the restructure rollover. This probably wouldn't apply to most scenario, but it's good to know that there is this integrity provision that we need to be aware of. Now, I've talked about the CGT and income tax consequences. Obviously, when undertaking a restructure, you need to consider the GST implication as well. Now, if you transfer a business asset, you will want to consider whether it was displayed as a going concern and therefore it was GST free. In terms of another tax issue that you need to be considered is the WA transfer duty. Adriano spoke before where you have WA still have a duty problem, especially with business asset where you transfer goodwill as well as plant and equipment, etc. So that's the small business restructure rollover. I'm going to do a conclusion. So basically, in conclusion, all these rollover are available. Basically, if you utilize them, basically what it does is it disregards the gain and it puts the new owner in the shoes of the former owner. What we need as a tax advisor is that it is not usually clients come to us and then say they want to restructure their business. But however, in most cases, what we found is that it has to come from us, the tax advisor. We have to, review them, identify and the potential, and then we go through the clients, being proactive. We try to sell to the client. If there is an opportunity to restructure and we can utilize this restructure rollover. Again, need to go through the cost and the benefits. For example, the cost might be, there is a one-off transfer duty that the client has to pay. If, for example, you get a 2 million goodwill, the duty on that 2 million goodwill is well in excess of 100,000. But that doesn't have to be the end of the deal. It's up to the tax advisor, us, to identify what are the benefits. Maybe, asset protection. How do you quantify asset protection? How about, if you move to a company, there is a reduced corporate tax rate. There is a tax saving over the years, especially because you need to be ongoing. It must be an ongoing business. If you want to utilize the restructure rollover, the business must continue anyway. So there will be a bit of a income tax saving there. So there's a benefit and cost, and it's up to us effectively to sell it to clients and identify the opportunity. This is always a good tax planning meeting to have with your clients. I'll go through.
We might just, because of the time, Pete, we might just quickly go through the case study and we'll send the answers out to
everyone. Yeah, sure, no problem. Case study 1, basically a sole trader, Andrew, which has been carrying on a business for over 30 years. The market value of the business asset as at 30th of June 18 as follow. You have the asset goodwill, which is a pre-CGT asset, and the market value is 1.2 million. Trading stock post CGT 200,000, and plant and equipment post CGT 400,000. The client would like to utilize the rollover under subdivision 122A. Now the question is, what are the CGT consequences under this? Now first, for the new company, the consequences that it will basically inherit this cost base as well as the original purchase date, and the pre-CGT status of the goodwill will be maintained. However, what you need to consider is the trading stock, where it will be accessible under Division 70 at market value. Again, Adriano mentioned potentially because the trading stock are moved as a whole, you might argue that the market value, the wholesale value, which is could be the same as the cost of the purchase. So that means there's a net accessible amount rising. The second one is you want to sell the trading stock in the original entity by Andrew on a consignment on behalf of the new company. Now, importantly, what are the tax characteristics of the share issue in a new company? The shares will be would also, part of the share would also reflect the pre-CGT status. So basically, because the goodwill is a pre-CGT asset, and the goodwill comprises of 2/3 of the total value of the company. So that means 2/3 of the shares on issue would be pre-CGT, and 1/3 would be post-CGT. Now, is there a better way to restructure the business? Now, what if Andrew just transfer the goodwill rather than the whole business asset? Assuming they satisfy the condition, that means the share will be 100% pre-CGT, which might eventually be valuable when he decides to sell the shares down the track. If he decided to transfer just the goodwill, he needs to consider how to deal with the trading stock and plant and equipment. Again, trading stock, if you do it, you can argue the market value is the wholesale value, or you can sell it on consignment on behalf of the new company. Now, plant and equipment, similarly, you can probably lease to the new company and then derive the lease income, or you can argue that the closing written down value is basically the market value, and therefore there's the balancing charge is minimal. So in that case, you can transfer rather than using the restructure, the rollover under 132A, you can just trigger the balancing charges. Now we continue to case study 2. Basically the same facts, except that we want to explore whether they can do a restructure to a new company with a discretionary trust as the sole shareholder. And then obviously under 122A, the requirement is not satisfied because the shareholder is not Andrew. Under the SBRR, the small business restructure rollover, unfortunately, the ultimate economic ownership requirement is not satisfied. It's because the discretionary trust there is no fixed interest in the new company because the sole shareholder is the discretionary trust, and under the alternative tax, you won't satisfy because just before or after the transfer, the business asset won't be the property of the trust. So now, what is an alternative way? You might probably want to consider the new company with Andrew as the sole shareholder. Why do you want to choose this rollover over the 122A? It's probably because there is a significant market value in the trading stock. So you want to move everything together, you can do it under this restructure. While under 122A, you'll be up for a significant tax bill on that trading stock. How about if you move from individual to family trust? It's probably not a company, but at least if it's a corporate trustee, it provides a degree of asset protection. And then, the new discretionary trust can then distribute not only limited to Andrew, but also to other individual beneficiary or even a corporate beneficiary. That's it from me. Thank you, everyone.
So the only thing with some of these rollovers is obviously transfer duty can be